So I am Jonathan Freed. I'm an officer here in Media Relations. I'd like to welcome some of the new faces that we see, a few new folks on the beat here at the New York Fed. We're glad to see you. And welcome everybody joining us by webcast. And just to point out to all of you in the room, if you could please grab a mic when you ask your question, and at least the first time out, identify your news organization. That'll be helpful for all the cameras in the room and to let the folks following on the web know what's going on and who you are. And I'll look over the top of my glasses when I say it for melodramatic effect. A reminder that this is not intended as a forum for questions about monetary policy. We'd like to keep the focus on the topic today.
Monetary policy was yesterday.
That's right. Okay. Returning my glasses back to their full upright and locked position, we will begin the quiz section of the program. Who would like to go? Questions, anyone? Sure. Claudia, go ahead.
Claudia Hirsch, Market News. How do you do? I've got two questions, one kosher, one unkosher. The first in regard to your presentation, Mr. Abel. In talking to manufacturers and recruiters across the country, I get the sense that there are a large number or a significant number of production job orders that are going unfilled in that middle skill area. They've arisen from automation, for instance, automated lathe operators and programmers, and then old school jobs like welders. There simply aren't enough skilled candidates to fill those jobs. So is part of that decline that you're talking about in middle skilled jobs in part simply being unable to find the right candidates for the job? That is, the job openings are there, but those jobs can't really be created without the folks to fill them.
You know, we actually field questions similar to this in our business surveys. We go around the region, we talk to different firms. Manufacturing is obviously a very important sector for our region in particular. We've heard a lot of very similar types of complaints, I guess I would say, in terms of at a certain skill level within the manufacturing sector that it has been hard to attract that type of labor. But actually we find it not just for, you know, really high skilled, but even fairly basic skills like, you know, simple math and reading and showing up to work on time. So there does seem to be a sentiment out there among businesses that finding the right kinds of skills for, especially in these more skilled trade type areas, has become a challenge. It could potentially be contributing to some of these patterns. I think that there are other forces out there that are more important, but it certainly could be contributing to the overall aggregate patterns we're seeing.
Mm-hmm. And for the unkosher portion, I'm a journalist, so I have to ask a clarifying question, President Dudley, about yesterday. You mentioned that the federal funds rate may start to rise before the Fed ends its reinvestment policy. But would that apply to both Treasuries and MBS? There was some confusion yesterday as to whether you were just referring to MBS.
Well, the Fed has very few treasuries maturing over the next, really through 2015 because of the maturity extension program that basically extended the duration of the treasuries portfolio. So in the near term, we're really talking about, the rollover of mortgage-backed securities. Presumably, if liftoff and monetary policy got pushed out even further, I would argue that having the reinvestment take place after liftoff would apply for both agency MBS and for Treasuries. But the focus yesterday was on agency MBS because there's so few maturing Treasury securities over the near term.
Okay, thank you.
Okay, we'll let that one slide.
That was a clarification.
It was a clarification. It was. Anybody else? Claudia, could you have?
Oh, so sorry.
Thanks.
Hey, I'm Morten Bertelsen with Norway's Business Daily. Two questions for Mr. President. What is the implication of this for the economy going forward? And for Mr. Abel, I suppose one can assume that the automation of jobs will continue. We will see more robots and so forth replacing those low-skilled work positions. How do you see that in affecting this in the future?
I mean, let me just start. I mean, I think as the slides have shown, this is not sort of new phenomenon. This has been going on for quite some time, and I think it's something that you should probably think of as more secular than cyclical. Obviously, the when it occurs is because of cyclical factors, but this has been going on for the last few business cycles. What I think it underscores, at least to me, is the importance of education and the importance of making sure that universities, community colleges are talking to businesses and others about what type of graduates they actually produce, so that the people coming out can actually have the right skill sets for the jobs that are actually available. So it's not I think what this is really showing that in economic recovery, it's not the lack of job opportunities per se in terms of the number. It's really what kind of jobs are actually available. And so making sure there's a good matching between the skills that people have coming out of school and the jobs where the job demand is, I think is critical.
Sure, and I think I would echo those sentiments exactly in terms of the specific question about technology's influence on the labor market going forward. I mean, this is an issue that's being debated. There's a lot of different viewpoints on that, but I think that it's important to keep in mind that as technology evolves, there's likely to be some continued displacement, but at the same time, technology creates a lot of opportunities. And it's important to make sure that you've got the right set of skills to take advantage of those opportunities. And so again, I continue to think that it's important to first be aware that these trends exist. It's not just in the nation; it's right here in our region as well. And to use this information to help think about making technology work as a complement for your skill set as opposed to a substitute for it.
Okay, we have a question from New Jersey from Hugh Morley on the webcast. He's with The Record. What are the broader economic implications of the shrinking sector of middle-income jobs? Does it create problems, or can the economy move on quite happily with fewer middle-income jobs?
I'll take a stab. I mean, I think, obviously we're raising this because we think it's an important trend to focus on. It's important to first keep in mind, though, that while there has been some shrinking in the middle, I mean, that is still a very large sector in terms of, the workforce. So it's not as though this has gone to zero. Nonetheless, the trends that we are looking at here, job polarization in particular, it has contributed some to the overall inequality that we've seen in the nation and in the region. And so that is, a larger piece of the puzzle that this is contributing to, and it's something for us to be thinking about. And again, I think it all comes back to what does it mean for the kinds of skills you're going to need to be able to take full advantage of the opportunities that are going to be there in our region and nationally.
I would just say, the important thing, from my perspective, is to make sure that people have the right skills so that there's not long-term unemployment because of mismatch. In other words, that the skills that people have don't match the jobs that are actually out there. And as long as we can sort of minimize the degree of mismatch, then we can, that means we can get people employed. And if we can get people employed, that's good for the economy, good for the productive capacity of the economy, good for the budget outlook over the longer term. So minimizing that degree of people that want jobs, can't find jobs because they don't have the right skill set, I think that's what we really should focus on from a policy perspective.
Okay. Anybody else? Well, we have a question from Rick Moriarty in Syracuse at the Post-Standard. Why does upstate New York historically trail the downstate area in recovering from recessions?
Well, I mean, that's a very, there's a lot of factors that go into that. The region overall is, much more, in terms of the industry composition, it was much more heavily geared toward a manufacturing sector, which is a much more cyclical sector. We see now that a lot of these production workers, during times of recession and recovery, you don't get that bounce back. Instead, over the last several decades, we've seen that there's been, changes in terms of investments in technology, investments, elsewhere outside of the U.S. And so, because of just the industrial structure, it winds up being a more slow growth region relative to downstate New York. But just in terms of other things that drive population trends and employment trends, over the last several decades, there's been movements to other parts of the country, in part to take advantage of better weather and things like that. And so, all of these forces can combine to sort of have upstate New York be a somewhat slower growth region than other parts of the country, including downstate.
I mean, I think the good news for upstate New York is that a lot of the, sort of the manufacturing, displacement that's occurred over the last few decades. I mean, that's pretty far advanced as a process. And so it looks like that should be much less a drag on upstate New York going forward than it has been over the last few decades.
Definitely.
I'll just add, well, also New York, keep in mind that New York City went through a lot of this during the 70s. New York City used to be a big manufacturing hub, and New York City successfully transitioned much earlier. So it's
certainly doable.
it's doable. Yes.
Anybody here? Yes, Claudia.
Regarding the labor force participation rate nationwide, I'm wondering if the aging population and the first waves of baby boomer retirements is yet having a meaningfully depressing impact on the labor force participation rate. What can you tell me about that?
It definitely is, because I mean, if you look at the participation rate by age cohort, it's not just the 75 and over or 65 and over. It's also it starts in the 50s that the participation rate definitely comes down. So you're moving a pretty good segment of the population, into those later older age cohorts where participation rates tend to be lower. That said, within those cohorts, things may be happening a little differently, where people are actually in the 54 to 65 area, that they're actually the participation rate's actually, I think, stable. So you have to distinguish between what's happening in the cohort compared to what's happening as you're moving people from one cohort to the other. So it's really the fact that the cohort, the people who are older have a lower participation rate. But the actual trend in those groups is actually, I think, stable, or maybe even it's gone up a little bit for the lower age groups. So there's sort of cross currents going on there. When we look at the participation rate, I mean, we're trying to resolve how much of the decline is demographics versus how much of the decline is people that have been discouraged workers who are dropping out of the labor force. And it's hard to know for sure, because you have to have some sense of an estimate of what you think the demographic trends actually are in these different age buckets. But as near as we can tell, a couple percentage point of the decline in the participation rate from our estimates are due to discouraged workers. And so we would think that those people will probably come back into the labor force as the labor market improves.
And then how much of it would be, if you can tell, the actual retiring age boomers?
Well, I think the age where people retire, I mean, that's pretty, it's pretty discretionary. I mean, for a lot of people, and so that's a decision really probably tied more to, what's happening to the return on their investments, how much have they been saving, what's their, what kind of nest egg do they want to have when they retire? And I think it's a complicated decision, and probably depends mostly on the circumstances of the individual household.
So to clarify, you're saying that discouraged workers are, that might be a couple of percentage points of the recent decline in the participation
Correct.
rate? Okay,
Correct.
thank you.
Matt?
Hi, I'm Matthew Zeitlin from BuzzFeed, and I was just looking at the kind of overall chart of the employment recovery in the last 3 recessions and recoveries, and it's gotten worse every time. And it seems like in all those cases, the kind of level of growth going into the recession has gone down as well. And if is the problem that we're seeing could it also just be lower growth of the economy overall that then kind of is accentuated for these middle-skilled jobs when the recession happens? And if that's the case, would that change the kind of policy response to kind of helping those workers if the economy is just growing slower in general?
Where do you see that, in what sense is the economy growing more slowly this time going into the recession? And which chart are you looking at, I guess?
Well, just, I mean, the rate of growth in the 90s going into the recession in the early 2000s was higher than the rate of growth in the 2000s going into this recession. And, there's a lot of discussion over whether or not the secular rate of growth for the entire economy is slowing anyway.
Yeah, but I guess I would argue the growth rate of the economy, sort of the medium to long term, is really driven by, the growth rate of the labor force plus productivity growth. And so, if the economy is growing more slowly because the labor force is growing more slowly, or that productivity growth is not as strong, I don't think that really would feed into the job loss dynamics particularly. I mean, maybe there's a connection there, but I don't think it's an obvious one.
I mean, it's pretty clear that in the Great Recession, at least, demand really hasn't come back in the same way we've seen in previous recessions. And I think if we had gotten a stronger demand response, a lot of these issues that look like structural issues wouldn't be quite as apparent. So I think still, even though we're pointing out some structural changes in the economy, by far the demand piece of the story is the more important piece.
Anyone else? Richard?
Excuse me, Richard Leong from Reuters. Couple questions. First of all, I want to get the panelists' take on the implication of this data on the regional housing market and how that's going to impact, this concern that I think broader concern that has been raised by Chair Yellen recently about the housing market.
I don't know if you guys are prepared to.
I mean, the housing market in this region is, there's lots of different housing markets. I mean, Manhattan housing market is totally different than, the housing market in New Jersey and upstate New York. So I think it's pretty hard to generalize about the housing market. I think, in New York City in particular, I mean, a lot of people rent as opposed to own, and so it's quite different in terms of, speaking about the New York City area. I think that some of the same issues that have probably impeded recovery nationally apply here. For example, the fact that if you're lower credit qualities, have a lower FICO score, it's probably harder for you to obtain a mortgage. The issue in terms of student loan debt and people with lots of student loans debt on their books having trouble saving money so that they can actually buy a house and enter the, be a homeowner. I think that's probably a factor here. I think one thing that's probably less of a factor here is the issue that's apparent in some markets where the house price decline was so severe that the value of the houses is below the replacement cost for new construction. So I think that's probably less applicable here. But I think I think some of the broad things that are affecting housing nationally are probably affect most of this region. But I think New York City is sort of a special case.
Yeah, and also, it's, one of the reasons New York City's housing market has done better is simply because, as you saw, New York City's job and economy during this last recession has recovered more strongly than the U.S. So kind of if you look at the areas that where the job growth is the strongest, those also seem to be the areas where the housing market has done the best. So for example, northern New Jersey, we've seen lagging a little bit in job growth. The housing market's lagged a bit. Same thing in parts of upstate New York. So to some extent, obviously, there are many issues, sort of secular issues, that the housing market was very different in this last recession than it had been in the past. But in a cyclical sense, one thing that obviously helps housing is job growth picks up.
Yeah, I mean, job growth drives household formation.
Yeah. Household
formation drives housing demand. And so really, at the end of the day, job creation is really critical to housing demand.
Excuse me, another question. Maybe I'm just asking something that's very obvious, but I just want to know with this sort of the shrinking of this middle-skill jobs, whether that is something that is partly causing the sort of income inequality that is being spoken about, because these jobs doesn't seem to be coming back after each successive recession.
Yeah, we did a briefing on this a couple years back, actually, and so job polarization it's actually a combination of things. It's not just employment growth at the upper end and the lower end with the shrinking middle, but if you look at wage patterns as well, wage growth has increased at the high end. It's more or less held steady in the middle, and actually we've seen some modest wage growth at the low end. So it actually is both of these things. It's growth at the high end and low end in terms of employment and wages. When you put all of it together, we've shown pretty clearly that it does contribute to inequality. But again, inequality is a very, very complex issue to think about. There's all kinds of things contributing to it. If you were to sort of think about where's job polarization having its effect, it's more in terms of sort of the 90-10 spread, the 90th percentile, 10th percentile spread in terms of inequality is probably having much less of an effect on the top 10%, top 1%, top 0.1% type of an effect. It's certainly there in terms of technology and globalization are forces that really high skilled people are able to take advantage of. But my guess is that it's probably contributing more to sort of the 90-10 than to the really upper end piece. There's other forces at work there.
I have another question from Hugh at the record. He's saying, why is New Jersey slower in recovering jobs lost in the recession than other parts of the region and the nation?
I mean, this is a really good question. I think that there's not just one thing at work here in New Jersey. There's probably a combination of things going on. Again, I'll start with just the history is important. So, thinking back to when the recession actually occurred, housing was an important part of what drove that cycle. And at least, relative to other parts of the region, New Jersey took a more direct hit on the housing front. House prices declined much more and recovered a lot slower. There's obvious feedback effects between the housing market and the labor market, as we were just talking about. And so the fact that New Jersey had this hard hit on the housing front was a initial difficult thing to recover from. In addition, because it did have a little bit more of a housing boom and bust than other parts of the region, New Jersey got a little bit more over leveraged than other parts of the region as well. And actually, if you look at the most recent report on household credit and debt, you can still see that the debt per capita in New Jersey is far above the U.S. and really hasn't come down like it has in the U.S. It's more or less held steady at a higher level. So the implication of the leverage is that places with a little bit more leverage actually took longer to recover. So the housing and the leverage are contributors to what's going on in terms of just the depths of the recession and the weaker recovery. There's probably something going on in terms of the industry composition in New Jersey as well. First, government jobs were shed earlier on in the process, which had an effect on the economy. Also, in terms of industry mix, things like pharma and telecom are big in New Jersey, and really haven't bounced back like other parts of the sector. And then, more recently, over the last couple of years, New Jersey's been hit by some pretty hard weather events as well. And so, if you put all these things together, they're each playing, I think, some part in why the region seems to be struggling a bit more than other parts of the U.S.
Jason, did you want to add something? You look like you did.
No.
You're good? Okay.
I was going to mention Sandy, but Sandy affected certain localities in New Jersey pretty harshly, and it's not clear that they've all come back. Weather.
Anybody else? Matt.
Matthew Bosler, Bloomberg News. Going back to the labor force participation debate, some of the reasons people have cited for leaving the labor force in the current population survey include, aside from retirement, obviously disability has been a big trend, and staying home to take care of family, these sort of things. Some of these other categories besides retirement, to what extent are those going to be like structural dampers going forward versus more cyclical?
Yeah, I think that we don't really know for sure. I mean, that's why there's so much debate about and uncertainty about what the participation rate was. I mean, I gave a number of what our sort of working estimate is 2 percentage points, but there's a lot of uncertainty around that because it's hard to adjust for all the factors that are affecting participation rates. So I think some of the things that you raised are legitimate questions, and they create a bigger amount of uncertainty about where the participation rate is really going to go over the next few years. I mean, it's going to keep, I think the long-term trend is still downward, right? Because the population is aging and you're moving people from high participation rate cohorts to lower. But how steep that decline is and whether is uncertain, partly for some of the factors that you raised.
Yeah, and to I guess what extent that could spill over into younger age cohorts, perhaps the effects of sort of an aging population.
Yeah, I mean, the one good thing about demographics is that we sort of know what's going to happen in terms of how the age groups are going to evolve. So I guess I don't think there's so much uncertainty about this spilling into younger populations. I mean, one interesting issue is people seem to take longer now to finish school. And that seems to affect participation rates in some of the 18 to 25, 24-year-old categories. So there are a lot of different cross currents going on.
Okay. Any other questions? Claudia. Is it kosher?
I think so. Nationally, on the household formation rate, which I know is difficult to measure, but is there any encouraging news that household formation from rentals to new homes to resales are accelerating at all as job creation accelerates?
I don't know the answer to that. I guess I can't say I'm familiar with the most recent household formation statistics, but I can tell you very confidently that the correlation with job creation is pretty darn high. So that's partly why I don't really focus on it.
Yeah, I think household formation first. The data are lagged. So if there was something very recent going on, it takes a while for it to get into the.
So we typically just look at employment, and that's.
I mean, look
such a
at
good
housing,
predictor.
new construction in a sense. I mean, obviously, just like there's mismatch in employment. So if there's, if you could have theoretically a lot of houses that are going empty and then there's excess demand somewhere else. But over the long haul, if you look at sort of housing starts, housing construction, that is sort of proxy, I guess, for household formation. And so that still remains fairly low, but
You could look at the rate of housing units that are constructed. You can sort of make some assumptions about how many housing units are raised every year, and then you can look at the vacancy rate and the inventory of unsold, homes, and you could construct some sort of, if you wanted to do that, you could construct a rough measure of a more current household formation rate. But I don't think it'd be a very good measure because, a lot of these housing statistics are poorly measured.
Anybody else? Going once? Matt?
So earlier in the briefing, you mentioned how, President Dudley, how among high-skilled jobs in New York and downstate area, that financial jobs are kind of lagging the rest of them. Is that something that you think is, one of these cyclical things, like in 3 years will be different, or is there kind of changes to the financial sector that would kind of cap the number of jobs or slow their growth permanently?
I mean, I think the answer is we don't really know for certain, but certainly two things are going on that are probably noteworthy. One, some firms are moving jobs out of the city to other areas of the country, but there are lower cost places of doing business, so that's probably going to be a factor. And number two, we know that the regulatory regime has changed in a pretty significant way. And one would certainly expect that regulatory regime probably is going to, take a little bit of the sort of forward momentum out of the financial sector, at least while the financial sector is adjusting to that new regime. Now, what happens in the longer term, where that new regime is fully in place, it's hard to say. I think it's really hard to say.
Okay. If there are no other questions, we will thank you all very much for coming, joining us today, and we'll see you next time. Thank you.
Thank you.